I'd like to welcome you all, first of all. And let you know that Jeff had asked me to do this about 3 years ago. This would have been a very short speech on coins and bars, and some futures and options maybe. But the more I delved into this topic, I realized that, well, certainly it's going to be an ETF-centric presentation. And let's start with the basics here, because the recent financial crisis precipitated a period of low to negative real interest rates and accompanying US dollar weakness, coupled with growing concerns about future inflation levels. They've all converged to continue to present quite a positive environment for investors who are looking to place money into commodities in general and in platinum group metals specifically as part of that sector. And as a result of such conditions, there has been a notable and steady rise in the levels of exposure that such metals have now appear to have among global investors since at least 2007. But for the purposes of today's talk, I will focus on the investment landscape in PGMs for the period that covers really the last 2.5 years. Because if I can safely assert anything here today, I can say this: if there's ever been a sea change in PGM investment trends, this period is the one to parse. These 30 months are the pivotal shift period in such manners. Because just as has clearly been the case with gold since 2004, the advent of ETF-based investment offtakes really marks a pivotal event in the PGM market, and a development that I hope, at least from my perspective, comes without some of the risks and potential dangers in the gold market being now faced because of the advent of gold ETFs. And you all know how I rail on those dangers in many of my commentaries. PGM-based ETFs are really germane to the investments in physical platinum and palladium because they're very important to the above-ground supplies of platinum, as these investment vehicles literally isolate sizable quantities from the readily available unallocated global inventory into allocated holdings, which are then being warehoused on behalf of these issuers. So in a sense, we might say that the holdings of platinum group metals in ETF are really sort of an off-exchange hoarding of physical metal. And whether or not they compete with the users, well, remains to be seen. Typically speaking, historically speaking, a very large majority of investment in physical platinum and palladium has come from Japan and from the US. We all know that the Japanese investing public has exhibited a long-standing tradition of investing in this metal, and it has therefore also probably been aware of and quite keenly interested in participating also in the palladium market. But for the typical Japanese investor, the principal driver of previous cycles of PGM investment or disinvestment, as the case may have been, was price. I mean, for both the US and Japanese investors, the supportive supply and demand fundamentals of these metals also play a role, of course, and they've continued to present an equally compelling case for a continuing robust level of investment activity. We can't really say that PGM prices are not important to North American investors, but the main rationale for investing in them appears to be a fairly similar one involved in buying gold, as Erica just mentioned, and to some extent silver, safe haven, diversification of portfolios, a search for protection against perceived future inflation, and of course, as a go-to during periods of economic upheaval. By contrast, the growth of physical investment in PGMs in the old world is not as much a matter of not being aware of opportunities or not wanting portfolio protection, but it's simply the fact that the cost proposition of acquiring PGMs has been and continues to be hampered by the existence of pretty stiff VAT levies on various bars and coins. So for such investors, PGM-based ETFs could not have come at a better time. So let us begin with a quick overview of PGM investment-related developments in 2009 as they applied to platinum. Because in fact, when looking at the noble metals price strength during that year, it's evident that much of it came from the sizable increases in net long positions in NYMEX futures and contracts, and subsequently in PGM-based ETF investment allocations. It took about, well, close to a year after the launch of some of the platinum-based ETFs in '07 for them to really begin showing some sizable, as the G arrow, as the green arrow shows you, to show some sizable increases in balances. Initially, platinum investors really only had the ETF securities PHPT vehicle and the ZKB Circuit Cantonal Bank platinum-based fund, and then later on, of course, a couple of other relatively small similar offerings from Australia and Switzerland, which are the red arrow, came about. But after the market debacle in the spring and amid the fluctuations and the liquidation mania that developed in the middle of 2008, such investment vehicles actually showed fairly hefty levels of disinvestment, well, along with pretty much everything else that was being thrown out with the bathwater that summer. By the second quarter of '09, and then well into last year, the growth imbalances in these vehicles, as well as the sheer number of PGM-oriented funds, experienced nothing short of explosive patterns in growth. The big gorilla, of course, in the PGM ETF room, turned out to be the arrival of ETF securities PLPT vehicle, which is now traded on the NYSE, and so this time I believe 5 instruments are present by which global investors can access platinum at the moment. So it comes as little of a surprise, really, especially in the case of these metals, that we noted a 57% gain in '09 in platinum and a 117% rise in palladium, as tracked on the trusty Kitco charts. This kind of price performance, in fact, took place despite a fairly sizable gross surplus in the platinum market. In '09, I think it was about 850,000 ounces of overhang, largely due to slumping fabrication demand because of the crisis-induced fright. So clearly, the ETF investment niche took care of a good portion of the surplus that was overhanging the market. Such price gains, especially in the case of palladium, extended well into 2010, and they didn't show much in the way of slowing down until this year's natural disaster in Japan. In fact, even after the supply chain disruptions clearly impacted auto production that comes from that country, platinum, with one exception, brief exception in June, and palladium didn't really breach the downside at 1,700 or 700 for the remainder of this year. And so platinum and palladium investment in ETFs in '09 was not only something remarkable, but it was also something very steady and robust throughout the year. So we noted a net gain of 12 tons, about 400,000 ounces in platinum-based ETF holdings by the end of that year. 2/3 of that going into the PHPT that I mentioned earlier, the ETF securities vehicle, and London-based. At the end of '09, the largest platinum-based ETF remained that same vehicle. It had holdings of about 431,000 ounces. And also in '09, that Swiss ETF, the ZKB, added 120,000 ounces to its balances. That was a 95% increase for the year. So the year-end tally for '09 showed about 680,000 ounces, 21 tons of platinum in ETF holdings. In '09, clearly some of the platinum-oriented investment demand was fitting the label of a recovery play, while other purchase-supported developments, such as difficulties in the aforementioned electricity supplies in South Africa and the labor strife that continued to be present, also played a role. But the watershed event that galvanized many of the platinum purchases being made in late '09 was, of course, the advent of the US-based version of ETF Securities Platinum Fund offering. Now, in the case of palladium, more than about 500,000 ounces of metal were added to ETF holdings in '09 and another 1.1 million last year. And for '09, the additions to palladium ETFs were in effect a total amount that took care of about half of the amount of Russian sales to the marketplace. While in 2010, ETF inflows in palladium amounted to about 17% of mine supply for that metal. And much of the additions took place in the first 60 days of '09, but they did so even while the US dollar was staging a temporary rally, something certainly worth noting. Investors pay attention to palladium because it has much in common with that already what we see in platinum. But there are additional rationales for such art to consider when opting for what might be labeled as poor man's platinum. Chief among them is platinum's desirability and functionality as a less costly alternative to gold for those who in that market are beleaguered presently by high gold prices, jewelry fabricators specifically, and also it's a substitute for automotive industry-based users who might find platinum a bit too pricey. As well, some investors still consider palladium as relatively cheap when viewed in the context of its historical prices. And finally, investment demand for palladium has at times reflected the general flow of investors' money aimed at the overall commodities niche, of course. The assumption, I think, was alluded to earlier that Russian state-owned stockpiles of the metal might be effectively drawn down to nil in either 2012 or 2013 is still out there, and it still looms on the minds of some investors. Certainly it wasn't to be this year. So it keeps getting postponed, but eventually it might come to pass. Thus, by year's end, cumulative palladium-based ETF holdings totaled 1.2 million ounces, and they were up 77% for the year. But with the advent of the US-listed palladium ETF in January of last year, such total holdings climbed by another 607,000 ounces to reach 1.77 million ounces by April of that year. So balances of palladium in ETF investment vehicles have seen a steady rise for 3 years now, with the exception of what Erica just mentioned earlier for the current year. ETF demand constituted 6.6% of total supply offtake in '09, and it rose to an equivalent 7.5% of total supply through April of last year. I'm going to skip to the next one because time is of the essence. In terms of futures contracts activity, the final months of 2009 witnessed a virtual mushroom cloud of net long platinum positions from about 18,000 in September of that year to 27,000 by December. Some of the buildup, of course, was in anticipation of the soon-to-be-launched platinum ETF, which finally got approval on Christmas Eve, maybe. And on the other hand, European retail physical buying of platinum and palladium contracted after the first quarter of '09 and was pretty subdued for the remainder of the year. Now, in 2010, we had heavy inflows of investment funds into PGM-oriented ETFs. Really virtually without pause. That PPLP vehicle, which was launched on the 8th of January, was followed by an addition of about 330,000 ounces of platinum into holdings in 3 months' time. And there were no fewer than 6 new platinum-based ETFs launched last year. That was the highest number of launches of that type ever. And the additions were very robust. We noted platinum ETF additions about 551,000 ounces. It was a figure that was larger than the surplus of 305,000 ounces between newly refined platinum and fabrication demand. Also, in 2010, we noted a very heavy level of net long positions in NYMEX futures. More than 1.26 million ounces in long positions were reported by the CFTC at the end of December of last year. open interest in platinum futures at the end of last year was 1.95 million ounces. And that record didn't stand for very long, because by the end of January, the level of the same was reported at 2.07 million ounces. And the current year, through late May at least, from what statistics we have from Jeff's shop, platinum ETF investors have accumulated another 173,000 ounces of the metal, and the more recent figure was just mentioned. Albeit, the pace has moderated somewhat from last year's torrid levels. We also saw two new platinum-based ETFs, the iShares SPLT and the Sources ETP, traded under SPPT symbol on the London Stock Exchange. Their combined year-to-date offtake has amounted to about 20,000 ounces of metal. Now, Rhodium didn't have a particularly strong start in 2009 as the global cratering in auto output took its toll on the demand for this noble metal. Rhodium commenced the year trading near the $1,100 level, but it soon began to show signs of robustness, and it achieved a rise to the $1,400 area in the second quarter, and subsequently as high as the $2,600 mark by November. More than rewarding the patient and hesitant investor who might have taken a flyer on it in January. Because not too many had dared touch Rhodium after what you saw there on the screen, from a lofty level of over 10,000 to a cratering under 1,000 in a brief period of time. It's assumed that many buyers of high-priced Rhodium probably hung on to positions and basically, stuck it out, or that at those really low prices in late 2008, some brave souls said, hey, and to buy it. CPM team says that the typical investor in Rhodium would be probably a hedge fund or a wealthy individual. Kitco, in fact, began to offer physical Rhodium in units of 1, 5, and 10 ounce jars of actual Rhodium sponge in April of last year, as we see a potentially heavily expanding investment market for the noble metal. At the moment, would-be physical Rhodium investors can avail themselves of a relatively, for Rhodium anyway, narrow $100 bid-offer spread with Kitco's allocated Rhodium product. And of course, they can also enjoy the safety of world-class insured vaulting, as well as the savings and added future liquidity being implied by the elimination of the need to re-assay this product. And at the present time, Kitco offers the following spectrum of products. We have platinum, palladium, rhodium, Kitco pool accounts. Of course, a host of platinum and palladium bars, coins, and as I said, rhodium sponge in the jar form. They're all characterized by a basic narrow bid spread offer. We offer better liquidity than a lot of products in this category. And in most cases offer low or no cost insured storage. And of course, the latest offering, as I mentioned, since April of last year, is the allocated Rhodium product. And of course, Jeff tells me that, and tells all of us, I think, that what is needed at this stage is for Kitco and other Rhodium players, namely the Deutsche Bank physical Rhodium ETC, to get together and raise the awareness levels among retail investors about the unique properties of Rhodium and the positive supply and demand fundamentals which it presently still enjoys. ETF Securities, in fact, took a step in that direction with its GLTR offering, another means of investing in Rhodium. It's a basket ETF in which Rhodium plays a fifth part. Gold, silver, platinum, and palladium are all present. And of course, yes, we have to mention this category because that's all the speech would have been about 3 years ago. Platinum form in the form of coins and such, the landscape has become relatively barren for would-be investors. Most of the world's mints appear to be concentrating their efforts on the fabrication of gold and silver coins to the detriment of the less historically popular platinum and palladium merchandise. For example, last year the U.S. Mint sold only about 10,000 ounces in Eagle platinum coins, and it was really more than busy enough trying to just meet production goals for the gold and silver variety of the Eagle The RCM, Royal Canadian Mint, sold, I don't know, insignificant 200 pieces of proof platinum coins, largely for the same reasons as the US Mint. But down under, the Perth Mint continues to fill the gap for worldwide platinum coins demand with its own 1/2 and 1/10 ounce collectible coins. And they managed to sell about 320,000 ounces of such coins in 2010, which was about half as much as the previous year. But we do expect platinum coin fabrication demand to revive once again, possibly next year. An easing in the retail investment demand for gold. Of course, US Mint gold coin sales were down about 21% in the first 8 months of this year. And even the silver coins, which are still at lofty levels, it could free up some of the manufacturing capacity that was hijacked to fabricate these coins, and it might produce as many as perhaps 20 or 25,000 ounces of platinum coins. But the zenith was in 1988 when they sold nearly 500,000 platinum eagles. So at the moment we're plodding along with annual production levels of about under 50,000 ounces of this type of coin globally in terms of US and Canada. Now some of the recent developments that have caught investors' eyes have also resulted in some of them switching away from gold and into platinum positions. And it's been the condition of parity between the price of platinum and the price of gold. This circumstance represents what is to many a rare opportunity to buy platinum cheaper than it has historically been in relation to gold. Because over the past 20 years, the spot price of gold has rarely overtaken that of platinum. The lowest ratio between the two metals basically fell to 0.93 to 1 in October of 1992. And so again, opportunity may be knocking for some who have hefty profits in gold already. Our host and the team at CPM envisions platinum group metals to remain at, quote, historically high levels over the next decade. In its recently released long-term outlook, in fact, their analysts list their projections for supply and demand and PGM price scenarios in 3 conditions, probably good, bad, or horrible. The key findings in that voluminous and quite valuable book, I believe, is the quote that says the role of investment demand is expected to continue to grow in importance, having greater influence on prices going forward, and that the upward shift in investment demand, a trend that has been going on for the past few years, which I tried to illustrate here, has changed and is expected to continue to change the dynamics of these markets significantly. Well, this is precisely why I feel especially privileged to have been asked to cover this pivotal aspect of this unique set of 3 metals here and now. Most people know I've gone on record to opine that the next tranche of significant investment gains in precious metals may not come from gold or silver, but from the exciting and exceptional sector of platinum group metals, which I believe is one that presents a superior supply and demand statistical position and offers potentially more substantial gains than gold or silver do at current levels, while also possibly presenting us with a more limited degree of downside risk. And with that, I thank you for your attention. Any questions? It looks like I covered. Yes.
Yeah, just one. You briefly touched on the platinum gold ratio. Many traders and analysts feel that the recent platinum price is being influenced by the ratio of trading. How long is that likely to continue?
Well, in recent weeks, you've seen it last, fairly brief moments at a time. And it was largely a matter of really gold coming close to where platinum had already been. If you look back at the charts we had shown earlier, it doesn't tend to last very long in general. People seize the opportunity, and the traditional or the historical premium, I think, ranges from $200 to $400 easily. So to see discount or even parity for a lot of people, or even just $50 or $80 of a premium, is generally a motivator, sufficient enough of motivator for them to sell the gold and buy the platinum. Or if they haven't done the platinum and the gold's already in the core position, as many of our retail investors seem to show us, they will take a fresh position in the PT. Next presenter is Jon Nadler, Peter Duncan.